Good day, everybody, and welcome again to the channel. And today we will be talking and discussing all about management advisory services. Uh, to those who are new to the channel, please don't forget to hit the magic button, share, like, and subscribe. So let's start the topic. And the best way to start with is to make the definition. Let us give the definition of managerial accounting. So, managerial accounting is the practice of identifying, measuring, analyzing, and interpreting and communicating financial information to managers for the pursuit of an organization goals. So, just to make a comment on that, it is the managerial accountants who really assist the managers to make decision making. It is through the data and facts that would be supplied to them, and as what the managerial accountants really believe that would give the managers a more uh, clear view of what they will be decide on. So this is are all for the benefit of the business, no? Through these managers. So let us give a more clear or clearer view of the uh, role of the managerial accountants, no? Let us make a comparative analysis, financial accounting versus managerial accounting. Letter A, management accounting does not prepare general purpose financial statements. No, they do not really intend to make these financial statements for external use, but rather an informal reports really to assist the managers in the study and the analysis of cost and pricing figures for their future decisions in the business. B. Reports are prepared for internal use only and based on the necessity of the management. As what I've said earlier, whatever the management requires, this will be provided by the managerial accountants, no, through these reports, no, through these internal reports, which is considerably informal compared to the general purpose financial statements. Letter C, managerial accounting frequently deals with estimates rather than proven and verifiable facts. Compared to the financial accounting, the managerial accountants always do reports more often than not are ahead of time because these are really used for planning and forecast. Unlike the financial accounting department, they provide the financial statements which are based on the transactions, no, and verifiable documents because they do record whatever has transpired during the reporting period. Managerial accounting is more focused on forecast and on estimates. And eventually, even though they consider actual events, it is the time when they have to assess whether the actual uh, come up with the whatever estimates they did in the past. Okay, letter D. Managerial accounting doesn't have to comply with any standard when information is complied for internal consumption. Again, this is just for the satisfaction of the manager, so there is no really a standard on how to make the reports or a standard format in the preparation of the reports. It is just to satisfy the needs of the managers. Letter E, managerial accounting is not concerned with the proper valuation of assets, liabilities, and impairment, but only to their productivity. As what I've said, since the managerial accounting department is really concerned with the assistance to the managers, so their study, no? Their study is really focused on how to become productive, no? To become efficient. These are all based on the data that would be gathered by the managerial accountants. So that is one of the noticeable difference between the financial accounting and managerial accounting. Letter F. Managerial accounting reports on more detailed levels such as profits by products and product lines, customers, and geographic regions. At what I said, managerial accounting really is on uh, focus about these aspects, no? Profits, products, product lines, and geographic regions. Based on the data, they are more focused on the behavior of these accounts and these uh, particular aspects. Okay? So, let us carry on with the topic. Let us go on. What do we really mean by cost? Cost means monetary value of expenditures for supply, services, labor, products, equipment, and other items purchased for use of a business and other accounting entity. So, just to make a an follow up on this, everything we spend, no, any amount we spend is considerably a cost. No, in accounting we just have to classify this whether it is just an expense or it is considered as an asset. It will depend. It will depend on the uh, particular classification, or rather the recognition principle that we have to observe in accounting. It's whether uh, we recognize it as an expense or an asset, but in overall, whatever we spend for a particular in item or particular commodity or anything or another asset for that matter is considerably a cost as long as it is measurable and it is verifiable in amount. Okay, next topic with what are the types of cost. Okay, the first in line is direct cost. Direct costs, they are costs that are associated with the production. Anything we spend which are directly attributable to the production of a particular product or item. So, these are some of these direct costs that we can cite. Letter A, direct materials and direct labor. So as we all know, direct materials are the materials that we can say that are visible to the product itself once it is finished. Kung siya ay makikita mo pag natapos na ang product at siya ay visible to the naked eye, na nakikita natin kung ano ang outcome ng product, that is what we call direct materials. Ang pinakasample ko dyan, once na natapos ang isang sapatos, di nakikita natin yung leather at saka yung rubber. So, those are the direct materials. Letter B, direct labor. Direct labor uh, pertains to the payroll of those who directly handle the production, those who uh, really operates the machine or really handled the particular product, uh, to transform it into a finished product. Okay? Direct labor. Next, indirect cost. These are costs which cannot be traced back to an individual department. So when we say cannot be traced, they are not really visible to the eyes, or they are not really directly attributable to a particular department, kumbaga, these are common costs, for all, mga gastusin for all, if you have 3 departments or 5 departments, still we spend this cost, but not really intended for a particular department or a particular uh, transaction within the plant, within the factory or the manufacturing firm. So, indirect cost. Example of this indirect cost, salary of the maintenance staff. We can consider this as indirect cost because the maintenance staff, doesn't really identify himself to a particular one, unless this staff is really uh, uh, identifiable to a particular activity. It will no longer be uh, the category, but it would be considered as a direct labor. So another one, other expenditures of the entire building or common utilities, or any utilities used in the plant which is not really attributable to the particular department or particular product. This is also the utilities for all common utilities. Okay? Next, what do you mean by fixed cost? These are cost component that remains constant regardless of the actual production of goods or services. Actually, these are spendings which do not vary regardless of the performance or the level of production. Okay, for example, if the plant produces 100 units, the fixed cost will still remain the same. If they eventually lower down their production to 80, still the cost still remains constant. So, it is fixed cost. So, what cost can we consider as fixed? Okay, we have rentals. When we say rental, it is a regular payment, for a particular use of an asset, especially if you're just renting a building or an equipment. Whether you produce this month or not, you still have to pay for the rent of the particular place or particular equipment. Letter B, utilities. Again, utilities are not really uh, basing their cost on the level of production. If you have a telephone, no, there is what we call a fixed rate for that. Just the same with the water, the electricity bills, because as long as you use the electricity, whether there are uh, productions or not, you have to pay your utilities. Okay? Letter C. The insurance premium will be paid on a monthly basis, and it is considered fixed considering that they do not really uh, base their rates on the level of the production of the plant. Okay, letter D. Fixed salaries. Okay, we have the managers or the staff. So, we really have to pay them on a regular basis, whether they are there are productions or not, because they are non-production staff. Okay. Letter E, other amortization that would be considered as regular, no? Like the interest on loans. So these are non production spending. So it's still considered as fixed cost. Okay, next. What are variable costs? Variable costs are those companies' costs that are associated with the number of goods or services it produces. Variable costs move in direct proportion to the increase or decrease of the products or services produced. Okay, sample of these variable costs, the direct materials, and also variable indirect materials and supplies. Letter B, direct labor or variable indirect labor. Letter C, other variable overhead. So let us elaborate on this. These variable costs are the cost that varies depending on the level of production because they are direct. These costs are really attributable to the uh, production activities. Okay? If there are more production, more variable cost will be consumed or will be spent. Like letter A, materials. These direct materials, if you will produce more cars or more metals and more headlights and more other accessories of the car will be used. Those are direct materials. No? And letter B, direct labor. If you produce more, you will have a higher payroll because the direct laborer will consume or will be uh, engaging more on their machineries and will be engaging more on their particular area of responsibility in the production area. Okay, letter C, other variable overhead. As long as this spending varies, no, and really based on the level of production, it is considered a variable cost, no? And finally, if it really are controllable basing on the level of production, these are variable overhead. Okay? Next, what is a product cost? Product cost, these are the costs incurred to produce a product. So, what are the components of product cost? Letter A, direct materials, direct labor, and factory overhead. These comprise the total manufacturing cost. As we see in this uh, slide, these are the components of product cost. Okay? Next, what can we say about cost of goods manufactured? So, the very first item under this cost of goods manufactured is let us define what are manufacturing costs. Manufacturing cost, it is the actual cost incurred in a given production period. Again, that's what I've said on the upper slide. It is comprising of direct materials used, direct labor payroll for that particular production period, and C, this is letter C, production overhead, or the what we always know as factory overhead. Okay, so under this factory overhead expenses, we can identify the following, no? Indirect materials and supplies, indirect labor cost, and other indirect factory cost. Online with this, we have uh, building maintenance, machinery and tool maintenance, property taxes, pension costs, depreciation of plant and equipment, rent expenses, utility expenses. These are all uh, under this indirect factory cost. Okay? So let us move on. What do you mean by work in process? Work in process actually are the soon to be finished products, but by this time they are not yet finished, so they are called work in process. So these are unfinished product as of given reporting date. They are usually measured by percentage as to their production status. Okay, since these are uh, products, they are just labeled as 100 lower than 100% finish, like 85% finish, 75% finish, but the term is work in process. As of that particular reporting date, they are still in the production area, no, soon to be finished. Hindi pa sila natatapos by that reporting date. Okay? What do you mean by finished goods? Finished goods, these are goods transferred to the warehouse as of a given reporting period. So they are about to be, uh, since they are transferred already to the warehouse, so they are soon to be sold, no? Kaya sila ay part na ng goods available for sale. Finished goods are the products of the manufacturing process. Once finished, finished goods na nga sila, at they are transferred to the warehouse, no, as part na ng cost of goods available for sale. So what do you mean by cost of goods manufactured? Again, so we can simply define the cost of goods manufactured by giving the formula, no? Direct materials used plus direct labor equals prime cost. Okay? This prime cost will be added by the factory overhead, and to elaborate more, the direct labor and the factory overhead, that will mean conversion cost. But overall, direct materials, direct labor, and factory overhead will mean cost of goods manufactured. Okay? We have this formula again, ano? Direct materials, direct labor, and factory overhead applied, no? Will mean cost of goods manufactured. Once you have a work in process at the beginning, no, you have to add that to the manufacturing cost. Then, you deduct the work in process end to arrive at cost of goods manufactured. Okay, always take note of this formula to get the cost of goods manufactured. Okay, Another point of information, any over-applied or under-applied factory overhead costs, since these are predetermined overhead, no, they are usually charged to cost of goods sold. If over-applied, they should be deducted from cost of goods sold. If under-applied, they should be added to the cost of goods sold. Two methods of production or product costing. We have the job order costing and the process costing, which are to be discussed in another video because it will take really a long uh, period of time to discuss on all of this. But just to have an idea, these are the two methods of product costing, job order costing, and process costing. This is used to produce variety of products, and to add to that, the product will just go through a single process. Once you are under the process costing, that means to say the products has to go through more than one process. And usually the production is really in volume, and the production of goods are considered identical. No? The products are identical and voluminous in each number. Okay, that is process costing. Okay, another term we have to understand what is a direct costing. It is a costing method where only the variable manufacturing costs are assigned to the inventory and the cost of goods sold. Fixed manufacturing costs are viewed as expenses and they are not treated as product cost, but rather period cost in the time or the period which they incurred. Okay? That is direct costing. Again, only variable costs are distributed or assigned to the inventory and the cost of goods sold. Okay? This method is not really allowed for external financial statement but can be used internally. Okay? Just to add to that, this direct costing method is really used by the management in their cost analysis. That's why we have the cost volume profit analysis. This is really effective in the study of their production and the uh, sales aspect, no? Okay, so external financial statement must have fixed manufacturing costs allocated in the product. So that is the prescription by the uh, authority when it comes to pricing. So this is not really intended for external use, the direct costing, but rather for management use. Okay? The next one, we have the full absorption costing. Full absorption costing. This method of accounting costing which assigns all manufacturing costs to products, variable and fixed. This is in accordance with GAAP. As what I've said earlier, this is what the GAAP or the accounting practice, no, prescribe. The inclusion of all the manufacturing costs, whether variable or fixed. Okay? In this effect, the fixed portion of the factory overhead is being distributed between the cost of goods sold and the ending inventory of the period. I hope you can understand what this means. That means to say that the fixed portion of the factory overhead will be distributed between the inventory which are sold and the inventory which are not yet sold, and rather in the asset section of the balance sheet, no? The inventory section. The objective of IAS 2 is to prescribe the accounting treatment for inventories. That's why in the direct costing, IAS 2 is being violated. That's why it is not really intended for external use because of this statement coming from IAS 2, because it provides guidance for determining the cost of inventories and subsequently recognizing expense, including write down to its net realizable value. It also provides the cost formulas that are used to assign cost to inventories. That is based on the IAS 2. Again and again, uh, this is the prescription which the direct costing violated. So that's why it is not really for external but rather internal. The full absorption costing is the costing method that follows the GAAP and the IAS2 statement. Okay? Next, product cost, variable costing. We have the direct materials, which is considered variable. B, direct labor, another variable cost. And C, only the variable factory overhead. So, meron tayo dito sa ilalim. We have a sort of a note. This is for management accounting only. Full absorption costing, direct materials, direct labor, and the fixed and variable um, overhead. Okay. This is in accordance with GAAP. Okay, we have to illustrate. Okay, may illustration tayo, no? Let's see. If there is a net sales of 1,400,000 of goods which are manufactured in this period, comprising of the variable cost, 630,000. The fixed cost during the manufacturing is 315,000. And in the process of their operation, the operating expenses comprise of the following: variable operating expenses, 98,000, and fixed operating expenses, 140,000. During the manufacturing, the following are gathered. Units manufactured, 70,000 units. Then, the units sold is 60,000, and the finished goods, beginning. We have no finished goods at the beginning of the year. Okay, let us analyze. Number one, let us answer the following questions. How much is the finished goods inventory at year end under variable costing and full absorption costing? Okay, so let us see. Total variable manufacturing cost, 630,000 as what is given. Okay, so we have to divide the number of units using the number of units produced. So we have to divide the total variable manufacturing cost. So variable cost per unit will result to 9 pesos per unit. That is by dividing 630,000, total variable manufacturing cost by number of units produced. Okay, and we got 9 pesos per unit. Okay, let us compute for the ending inventory. Okay, consider the production and the units sold. Okay, and the ending inventory is 10,000 units multiplied by the variable cost per unit. So the ending finished goods inventory is 90,000. That is under the variable costing. Now, let us see the full absorption costing. Okay, let us check this first. Okay, under the full absorption costing method, total manufacturing cost 945,000. Why? Okay, it is based on the following: total variable and the total fixed variable or manufacturing cost. 945,000 is the total. Okay, total manufacturing cost divided by the production in units, and the unit cost is 1350. Okay, to get the ending inventory, we have just like what we got in the variable cost, 10,000 units, the same, 10,000 units multiplied by unit cost. How did we arrive at the unit cost under full costing? So, it is just the total manufacturing cost divided by 70,000. Yun, 1350 per unit. Okay? So, the total amount of the finished goods and under full costing is 135,000 pesos. So, let us see. They do differ in their inventory. How will this difference in the inventory affect the performance of the business? Again, the question is, how does this difference in their inventory affect the operation or the performance of the business? No? Let's see. So, with that, we have to make the income statement under variable costing. Okay, the net sales, 1,400,000 as what is given, 1,400,000. Variable cost, 540,000. How did we get this 540,000? Okay, we get this by multiplying the number of units sold by the unit cost. So you can see that 60,000 times 9 pesos. And also, we have to get the variable operating cost, because that's how variable costing works. All the variable costs should be deducted from the sales to get the contribution margin. Not only the manufacturing cost, but the variable operating cost. So, like stated here, 98,000 is the operating expenses, which are considered variable, 98,000. So, we added that to the variable cost section. So, contribution margin. Contribution margin is the result by deducting variable cost from the sales. Okay? Okay, by definition, contribution margin are the peso value in excess of the sales over the variable cost. So, these are the portion of sales which are not covered by the variable cost. So, any excess of the sales over the variable cost will be the contribution margin. Or in simple language, this is the portion of the sales which will cover the other operating or fixed operating and manufacturing expenses, for that matter, considerably fixed, to arrive at net income. Okay? So, this contribution margin uh, will be the amount, no, to cover up all these fixed costs, whether manufacturing or operating, to arrive at net income or net loss, depending on how this contribution margin rate. No? If this is much lower than the fixed cost, it would result to a net loss. If it is above the fixed cost, it will result to an income. So, with this report under the variable costing, we can see that there is an uh, income of 307,000. Let us see the net income under full absorption costing. The same with the sales. The cost of goods sold, that is 60,000 multiplied by 13.9. Okay? Or rather 13.5. This is the unit cost under the full costing, 13.5. So the result is 810,000, and we get the gross profit. By the way, this full absorption costing income statement is what we call the traditional income statement, no? The usual income statement that we know. Okay. Once we arrive at the gross profit, we will less the operating expenses. The operating expenses, ano? These are the operating expenses. So, it totals 238. Yan, 238. So, with that, gross profit minus operating expenses, we ended up with 352,000 as net income. So, comparatively, how much is the difference? Okay, we can see that there is a difference. So, the total difference is this, no? More or less 45,000. Okay, but we have to analyze how did this difference come, no, to existence. Okay, under full costing, ano? Okay, by the way, this is the analysis on how this 45,000, no, uh, come to this report. How can we uh, account for this 45,000 difference between variable and full costing? We can see that the full costing has a higher income, net income reported compared to variable costing. Okay, this is the analysis. The unit cost under full costing, 1350 as what we have computed, no, a while ago. Variable cost per unit, we have 9 pesos basing on the computation for variable costing method. The difference is 450. This 450 now per unit will be multiplied by the actual ending inventory, no? The ending inventory is 10,000. So, we get this 45,000, which is identical to the difference of the net income between variable cost and the full costing. So, in analysis, we can say that what will make the difference between the two methods of costing is lies, no? We can say that it lies on the fixed factory overhead that is assigned to the inventory. the portion of the fixed cost that, or rather the fixed factory overhead that is assigned to the inventory not yet sold, no, made the cost of goods sold much lower than the cost of goods sold reported by the variable cost. So all in all, that means to say that the cost of goods sold under variable costing is quite higher compared to the cost of goods sold in the full costing, because the fixed factor overhead portion is not yet considered as expense but rather an asset, which is still in the asset section of the balance sheet. So this is the portion, 45,000 for the 10,000 units, and the 4 pesos and 50 centavos per unit, which is still in the inventory, no, to get the total of 45,000. Okay? Again, no, ending inventory, full costing 135,000, ending inventory variable 90,000. Because of the fact that the ending inventory in variable costing is lower, no, in effect, no, it reports a higher cost of goods sold. So to get the effect, higher ending inventory, lower cost of goods sold. Lower ending inventory, higher cost of goods sold. So in this case, the full costing has higher net income, and also a higher cost of ending inventory. I hope everybody understand that. Okay? Okay, for more analysis, let us continue the event. Let's move on to the next year. What if production next year increased by 10%? The number of units increased by 10% and sales decreased by 5% considering other are constant. But only the sales volume decreased by 5%. Okay, so let us do the income statement. Under variable costing, the sale is 1,330,000. That is 95% of the previous sales. That's why 1,400,000 multiplied by 95%. So this is the sales for the year. Again, we will apply everything being constant. Variable manufacturing cost is still the same, 9 pesos, because that's the character of the variable cost. It varies to volume, but it remains constant to an individual basis. So, still, 9 pesos pa rin per unit, but the volume change because of the decrease in sales. So, right now, right at this year, only 57,000 units sold at the rate of 9 pesos for variable manufacturing cost. Also with variable operating expenses. Since 57,000 is sold, now we will multiply it by the variable operating expense per unit, 1.6333. This is the per unit cost of operating expenses, under variable category, because that is the rate per unit sold. Okay? 57,000 multiplied by 1.6333. Okay? So, total variable cost, 606,100. We deduct the variable cost from the sales. We get the contribution margin, And the fixed cost is 455,000, still constant, 55,000. That's the character of the fixed cost. Remains constant, whatever the operation uh, change, whether increase or decrease, the fixed cost will still remain the same. So, the net income is 268,900. Please take note of the net income. Okay? Again, we have some data here at the right. The selling price basing on the computation is 23.33. That is 1,330,000, no, divided by number of units sold. Okay? The same, the same. The selling price will remain the same compared to the previous years, okay? Because no information about any change in selling price, but the change in sales volume by 5% decrease. Okay, the same with the variable cost. No, if we will compute the percentage of variable cost, percentage to the total net sales, 45.57%. Again, we get the 57,000 units, number of units sold. Okay, so we will now go to full absorption costing. The same, sales of the company under full costing is 1,330,000. The cost of sales will now change because of the fact that we have a beginning inventory, no? We also consider beginning inventory here in the variable costing, but it is evidently will not make any difference because whatever happens, the unit cost of the inventory or the cost of goods available for sale under variable costing will still remain constant by 9 pesos per unit. Only the variable uh, portion of the manufacturing cost. But this time, in full absorption costing, it changed because we had unending inventory last year. So 10,000, 1350, that will be part of the cost of goods sold this year. So the regular, the normal, we will be using the first in, first out. 10,000 units, 1350 per unit, 135,000. And also the unit cost this production period, here it is. Sabi kasi, nag-increase daw, ng 10% ang production. So, the production this year is 7,000 more. Kaya, 77,000 na ang production. But again, as we all know, the variable cost, for this production, it varies in direct proportion. It changes in direct proportion to the change in production. Kung nag-increase ang production mo, mag-i-increase din ang iyong variable cost. But the unit cost, variable cost will be constant. But definitely your variable cost increased. Okay, let us check, kung titingnan natin, ang variable cost sa manufacturing dito ay 693. Pero sa normal, sa dati nilang cost ng, ang variable cost ay 630 lang. 630,000 variable manufacturing cost. Kasi 700,000 units, 70,000 units lang ang na-produce. But this time, ang na-produce ay 77, kaya madadagdagan din ng 7,000 times 9. Okay? 63. So, tignan natin kung 63 nga nadagdag because 7,000 times 9 is 63. Nadagdagan ba ng 63? Let's see. 630, total variable cost 630. Okay, the same here with the given. Then it became 693. So nag-increase nga ng 63. That is 7,000 times 9, 63. Okay. Fixed manufacturing cost 315. So fixed nga siya kaya it remain. But still this is a full costing. Idadagdag natin yung fixed manufacturing cost. So total manufacturing cost is 1,008,000 divided by 77,000 units. So, ang isang unit ay nagkakahalagaan ng 13.09. So, unit cost now is 13.09. This is where this figure is extracted, 13.09. So, another 47,000 from the new production will be sold. 47 because the total number of sold is 57 minus 10,000, 47 times 13.09, 615,272.73, and we have a what we call cost of sales na 750,272.73. Now we will deduct it from the sales and we got gross profit 579,727.27. The operating expenses that is 57,000 times 1.63333, basing on the per unit sold, the same. Whatever is the per unit above, the same here sa operating. And also, the fixed operating expenses will remain the same because this is fixed. So, ang total natin na operating expenses, 233,100. So, the gross profit minus operating expense is 346,627.27. The difference of 77,727.27. So, let us analyze. Ano ang analysis natin sa difference na to? Still the fixed or full absorption costing displays a higher net income. Yes. Mas mataas na ang kanyang difference by this time because dito sa una, ang difference nila ay 45,000 ang difference, Here it is. The difference is 45,000. Ayan, sa net income at saka sa inventory. But at this point, ang difference na natin ay 77,727.27, So, let us analyze. Siyempre, nasa ending inventory na naman ang difference niyan. Ang beginning natin, 10, the same yan. Produce 77, the unit sold 57, and the ending inventory in units is the same. And the only difference is their cost per unit. Okay. Ang ending inventory mo ngayon sa full costing ay 392,727.27, but the ending inventory mo sa variable costing ay 270,000 with a difference of 122,227.27. So, they do not really agree with each other. Unlike doon sa nauna, Kung ano yung difference sa inventory, yung difference yung sa net income. No more because may beginning inventory ka na eh. Doon wala kang beginning inventory, kaya they agree. But this time, kung anong difference sa income statement is not the same with the ending inventory. Paano nangyari yon? Siyempre, in the operation, meron kang beginning inventory, part yan ng cost of goods sold. Okay, if you will analyze, if you have a beginning inventory, i-add mo yan sa cost of goods sold. So ang analysis, mas mataas ang beginning inventory ni full costing. Kaya ang effect niyan, mas mataas ang cost of goods sold niya. At kung mataas ang cost of goods sold niya because of the beginning inventory is higher, that will make the resulted net income lower, supposedly lower dapat ng 45,000 because of the beginning inventory, no? Yan yung 45,000 difference, ano, yan yun, yung nakita nating ending inventory. Ito yon, no? That is the difference, 45,000. Also, dadalhin din niya dito, yun yung difference. Since mataas, ano, no? Where is this? No? Since mataas ang ending inventory ni full absorption, no? Ang effect diyan ay mas mababa ang net income niya by 45,000, no? 45,000 kasi ang difference sa kanilang ending inventory. Okay, so may 45,000 tayo, indicate natin na supposedly under ng 45,000 ang net income ni full costing. Pero bakit? Mataas pa rin siya ng 122, no? Mataas pa rin. And rather, no, the net income is mataas ng 77. But the ending inventory is higher by 122. Okay? So, at this point, mataas pa rin ang ending inventory ni full costing. Anong effect nun? If the company has a higher ending inventory, the tendency is mas mataas ang net income niya dapat. Mas mataas siya ng 122,727.27. So, ang in effect, mas mataas ang kanyang result net income by this amount. So, yung una, yung beginning inventory, bababa ang effect. Ang effect na ito ay makakapagpababa sa net income niya. Pero yung ending inventory, magpapataas naman sa net income niya. No? Kaya ang overall effect diyan, ang overall effect ay 77,727.27. Nag-offset yung overstatement ng beginning inventory at overstatement ng ending inventory. Kaya ang effect sa net income niya ay neto rin net na 77,727. That's what happened dito sa net income niya. Okay? Kaya ang net income niya ay tumaas lang ng 727.27. But we do not have to forget ng effect sa inventory ay mataas pa rin ang full costing ng 122,727.27. So, now, they offset no? Overstatement ng beginning, understatement of income. Overstatement of ending, overstatement of income. So, to get the net effect, 77,727.27, which is the difference sa kanilang net income. Okay? So much for that, ano? I hope everybody understands. But let us now proceed. At what sales level is the company's break-even point? It is the level of sales wherein the company will suffer no loss or will have an income. No? Walang kita, walang net income, but also at the same time, wala namang loss. So, this is what we call break-even. Okay, let's get the information above. Kung ano rin yung mga given. Sabi, ang selling price dito ay 23.33 basing on the computation. So, these are the information needed. Selling price. Variable cost, 10.63. How did we get that? Because of the fact that we compute for the percentage. What percentage is the variable cost, no, against the selling price? So if we will compute basing on the past information, the variable cost is 45.57%. Like this one, no? These are the bases. These are the original figures. Kaya be-base mo. 638, no? Sabi dito, where is the 638? Ito yan, yung variable. If we add, no, the variable operating and the variable manufacturing, ano, yun ang basis ng kanyang computation. Kaya, variable, 63, okay, okay, 8, 7, 3, 8, ano ba yun? Let us see the percentage. And 14 divided by, let us see the computation. Because basing on the past formula, no, ito kasi, 638. So, asan ang basis nito? Where is the 638? Variable cost. Okay, let's do it actual, This one. Okay. Just the same. We will divide the total variable cost by the selling price. Just the same, 46%. Okay? So, we just try to make it sure, 46%. No? This one is, if we will, the same, kung wala siyang decimal, 46% talaga. Okay? So, let us use the percentage. Yun. Kaya, nag-10.63 siya. This is 46% of the selling price. And the contribution margin is 54% now with that formula. Okay? And the fixed cost is 455,000. So, let us use the data, break-even points in units. That is, the formula is the fixed cost will be divided by the contribution margin per unit. Okay? So, lagay natin dito. Divided by contribution margin per unit. Yan. Yan yun. Ito yun. 1270. Contribution margin per unit. So, the break-even point will be in units also. Ayan. 35,827 units. At this sale in units, break-even point siya, walang lugi, walang kita. But, how can we translate that into peso? Di multiply mo sa unit selling price. Ayun, selling price. So, this is the break-even point in peso, 835,958.01. So, let us try sa income statement. Yun, 835,958.01. Multiply mo yung variable cost. So, ito magiging variable cost niya because we are using the same variable cost percentage. And we will arrive at 455,000 contribution margin. And we will deduct the fixed cost na 455,000. And now, based on net income, walang kita, walang lugi. Break even point siya. So, that is the selling level, sales level at which the company will suffer no loss and will have no any income. Break-even point in peso and also break-even point in units. So with that, I hope everybody understand and let us end this with a positive note And uh, stay safe and see you sa next video natin. Thank you very much.